Assalamualaikum warahmatullahi wabarakatuh to Dr. FAISOL with ILHAM. This is a video presentation of our project from Group 3. My name is Runner Aslina Bintury Ismail, matric number 2810 and 55, and I will present about the important findings of our project on Mfrs 108, changes in accounting policies, estimate and errors. Okay, according to the selected financial year annual report, which is from 2018 to 2020, FGV Holdings Berhad and Halal Corporation Berhad only have one financial year that have amendment of new accounting policy with effective date on 1st January 2020. Next, for GPA Holdings Berhad, it has announced and listed the amendment of accounting policies with effective date on the financial year 2019 and 2020. Lastly, for Cihin Group Berhad and Sandal B Plantation Berhad, both of it have announced and listed the amendment for new accounting policy with effective date for the financial year 2018, 2019 and 2020. To summarize regarding the Mfrs 108, all the 5 companies selected mostly did not experience any material impact during the current year due to the change either in accounting policies or estimates, except for the Sandal B Plantation Berhad, which is for the financial year 2018 and 2019. The companies usually provide or disclose sufficient information in the annual report according to the changes they made. Mostly, they have stated a list of amendments in the annual report together with the effective date of those amendments to ensure a comprehensive presentation regarding the changes. Okay, financial implication of a new accounting pronouncement for Sandal B Plantation Berhad is Mfrs 9, which is a financial instrument which adopted for the first time in the financial statement, which has resulted in changes in accounting policies. The cumulative effect of initially applying Mfrs 9 were recognized as an adjustment to the opening balance of retained earnings as at 1st July 2018. Next, the amendment that have impact on the financial statement is the annual improvement to MFRS 2015 to 2017 cycles on MFRS 123 on borrowing costs, which has resulted in the capitalization of additional finance costs of 48.8 million into property, plant and equipment for the year ended 31st December 2019. Other than that, the adoption of other amendments and IC interpretation listed on the financial year 2018 until 2020 did not have any impact on the current year or any prior period and is not likely to affect future period. Okay, that's all from me. Thank you.
Hi and Assalamualaikum. My name is Aida Zaira binti Ismail. My matric number is 281448 and I will present about the MFRS 110 events after the reporting period. Events after the reporting period are those favorable or unfavorable events that occur between the end of accounting period and the date of where the financial statement is authorized for issue. There are 2 types of events, which is an adjusting event that require the company to do adjustment as it provides evidence of conditions which existed at the end of the reporting period. The other one is the non-adjusting events that are indicative of conditions which arose after the reporting period. These events only require for disclosure because there is no evidence existed at the balance sheet. This is the summary of MFRS 110 disclosure among the selected companies. We can see that Cihin Group Berhad reported several events after the reporting period throughout the 3 consecutive years compared to the other companies. FGV Holdings Berhad and GPA Holdings Berhad only disclose about the issue of COVID-19 pandemic as their events after the reporting period in the year 2019 and 2020 respectively. These 2 companies stated that the COVID-19 pandemic expected to have financial implications to their companies as their business activities are affected by the Movement Control Order MCO, which gravitate the management to keep a close eye on the situation and will make any required decisions if needed. All of these 5 companies reported their events after the reporting period, which classified as non-adjusting events. In the year 2018, there are only 2 companies disclosed about their non-adjusting events. Chin Hin Group Berhad stated that there was incorporation for an own subsidiary company by an associate company of the business, while Hanline Corporation Berhad disclosed two events. Those events includes negotiation with third party in leasing out a hotel building to cease loss operations and disposals part of an estate by entering into the sale and purchase agreement. Move on to the next year, 2019, all of the companies disclose about their non-adjusting events except GPA Holdings Berhad. There are three events from Chin Hin Group Berhad, which is one of them is the reduction of shareholding due to the disposals of shares of an associate. Other than that, Hanline Corporation Berhad also stated three events after the reporting period that was classified as non-adjusting events. Now we look for the year 2020, there are only three companies reported the events after the reporting period. Again, the annual report of Chin Hin Group Berhad disclosed a total of three non-adjusting events. In addition, Sangabri Plantation Berhad disclosed that there was a recognition of the gain of land disposals. To conclude, all of these five companies reported several events after the reporting period as the non-adjusting events by providing the disclosure about those events because there is no evidence existed at their balance sheets which require no adjustment. That's all from me. I will pass to the next presenter.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Ashraf bin Mazlan and metric number 281063. So now I am going to continue to present MFRS 116 Property, Plant and Equipment. MFRS 116 defines property, plant and equipment as a tangible asset that are held for use in the production or supply of goods or services, for rental to others, for administrative purposes, and are expected to be used during more than one period. However, MFRS 116 is not applicable for PPE classified as held for sale under IFRS 5 and investment properties accounted for using fair value under IAS 40, biological asset that related to agricultural activity under IAS 41, and also exploration and evaluation of asset under IFRS 6. The objective of this MFRS 116 is to prescribe the accounting standard for property, plant and equipment, and changes in such investment. The principal issues in accounting policy of PPE are the recognition of the asset, the determination of their carrying amount, and the depreciation changes and impairment losses to be recognized in relation to them. Subsequent measurement under MFRS 116 is by using two methods, which is cost method and revaluation method. Under the cost method, the asset is carried at its cost less accumulated depreciation less impairment loss. Under the revaluation method, the carry amount of an asset at its fair value at the revaluation date less subsequent accumulated depreciation and subsequent impairment losses. From the analysis that we have performed to the five companies that we have selected, which is Chin Hin Group Berhad, FGB Holdings Berhad, GPA Holdings Berhad, Hanline Corporation Berhad, Sangabri Plantation Berhad, we found out that all these companies are using cost method to measure their property, plant and equipment. The method applied are disclosed in the annual report of each company under the notes to the financial statement. Each of these companies stated that property, plant and equipment are measured at cost less any accumulated depreciation and any accumulated impairment losses. I think that's all from me. Thank you.
According to the administration, key audit methods are those methods that auditor for financial judgment are the most significant area of the auditor financial statement of the current period. The purpose of key audit method is to enhance the communicative value of the auditor report by providing greater transparency about the auditor that was performed. This table shows the common and regular key audit method disclosed by all the selected company at least 2 years or for all the 3 years from 2018 to 2020. Thus, the impairment of trade receivable of change and GPA is highlighted as key audit matter because it involves a significant adjustment and estimation in the assessment of credit risk, exposure and collectability of trade receivable. And for example, in 2020, change recognized 368 million, which equivalent to 67% of its total current asset, which is believed to have a material impact to the financial statement. Next, the reservoir value of inventory or change is estimated based on anticipated sales price. The fair value of land lease agreement liability is based on cash flow projection, while the provision for warranty claim of GPA is based on estimate replacement cost from historical information. Next, the discounted cash flow model is used to determine the recovered amount of the asset or impairment of goodwill or HGV and SINDABI, which is believed involve also a significant adjustment. Next, impairment of PPP and ROU assets of HGV is based on discounted cash flow, while for the Harlan are based on discounted cash flow or fair value less cost of deposit and also due to its significance to the financial statement. In short, on this item is highlighted as key audit matter because it involves significant estimation, judgment, subjective assumption that could result in material change in profitability of the good or material change in financial statement. Since most of these key audit matter are involve significant adjustment, the external auditor adjusts all these key audit matter through evaluating and assessing the reasonableness of the key judgment used by management in estimate those key audit matter, and conduct other appropriate approach to address those risks. Besides, most of these key audit matters are those frequently reported key audit matters mentioned in some research article. Last, all these key audit matters is aimed to draw user attention to the significant matter of the financial reporting risk and important disclosure in the financial statement, which is useful for the user such as investment purpose. And that's all for me. Thank you.
Assalamualaikum and hi, my name is Nabila binti Muhammad Hafiz, metric number 280745, will be presenting the financial statement analysis. First is EPS. According to the data given, Chin Hin Group Berhad, Hanling Corporation Berhad and Sun Darby Plantation Berhad, EPS decreased from the year 2018 to 2019. This was because due to the sudden outbreak of COVID-19 that had affected the company's financial statement. Next, from the year 2019 to 2020, most companies' EPS had increased even during the pandemic because the companies might have the solution or the method to generate the growth in EPS or getting higher profits so that the investors can invest more for the company's share. Is return on assets. ROA measures how company's management in generating from its total assets. By looking at the data, Chin Hin Group Berhad, Hanling Corporation Berhad and Sun Darby Plantation Berhad have the same trend for ROA, which was decreased from 2018 to 2019 and then increased in 2020. The fall of ROA shows that the company were financially impacted due to COVID-19, and the rise of ROA shows that the companies might have the ways to overcome the fall. However, for the FGV Holding Berhad, it kept increasing from the year 2018 to 2020. So it means that the company might not have financially impact due to COVID-19. Unlike other companies, only GPA Holdings Berhad was the company that had decreased for ROA in 2020. Besides ROA, there is ROE. Return on equity or ROE is the net income of a company relative to the value of its equity. Just like the trend for ROA, the companies have the same trend happen for ROE. We could see that the ROE for most companies decreased from 2018 to 2019 because of the pandemic that affect the financial statements for the year and then increased in 2020. These were because either the companies were using the equity capital more efficiently or the companies were trying to build shareholder value to boost productivity and profitability. Finally, debt ratio. Debt ratio measures the amount of leverage used by a company in terms of total debt to total assets. So from the data, we can see that these 5 companies' debt ratio were consistently below 1 throughout these 3 years. So these companies prove that they had a stable financial statement despite having the difficulties during COVID-19 pandemic. So to sum up, the company had an increasing debt ratio shows that the company faced higher financial risk that was likely due to rise in the loan and borrowings, which is current liabilities and vice versa. That's all from me. Thank you.